Joining us right now is Savita Subramanian, head of equity and ESG strategy at Bank of America Securities. You heard what David Tepper had to say. The market may be overpriced, but then there's this other issue of can you fight the Fed or can't you fight the Fed? What do you do?
So, yeah, it's interesting because I think that what we've heard is policymakers, not just the Fed, essentially pull out all the stops. I mean, they've got our backs on this recession. But I guess the worry now is, what else is going to keep the market propped up? And I think, one of the things that we've noticed is, and I'm sure you've seen this as well, is that every time you get some kind of bout of stimulus, you see a lower risk rally than the prior bout. So, think about TARP. That saved the world in 2009. But then the next round, the subsequent rounds of QE produced lower and lower risk rallies. So I feel like, we're kind of maxed out in terms of stimulus. And what we really need to see is a clean reopening. So I don't know. I look at this as kind of a big moral hazard risk. The other thing that I worry about is what if the Fed intimates somehow that they may not be able to save us? I think that would cause a big confidence crash in the market because if you think about it, the Fed's bolstered this market pretty aggressively for the last, for over a decade now. So, I think we're in a bit of a tough spot in terms of how to get higher from here. I suppose the good news is for the S&P 500, and the reason that we're not outright bearish on stocks is that there is a huge percentage of the market that is comprised of recurring revenue, high quality companies. So amongst all of the equity benchmarks, I would have to say that the S&P 500 actually looks to be the most stable area in which to invest your money.
So you would invest in the S&P. The question is the bet at this point about health, or is the bet at this point about stimulus, or is it a combination of the two? And when it comes to the health piece, you talked about a clean opening. Everybody wants a clean opening. You talk to the health experts, you listen to Dr. Fauci, and he would almost make you think that almost by default it's going to be almost impossible to have a genuinely clean opening given what could take place. The question is are the American people, I don't want to say do they have a risk appetite, but a risk acceptance maybe to go back to work in ways that maybe with PP and other things keep going? And what does it mean just to go back to work? Because I could see lots of people go back to work, but then I'm not sure, are they going to still have the same kind of demand for products and other things?
Absolutely, Andrew. I think the question is, if you look at China, they had a pretty quick recovery, but China is much more manufacturing heavy and services light. But what we've learned from looking at China is that the services sector has been much more sluggish to come back. The consumer sector has been much more sluggish. And as you know, the U.S. is tethered to consumer and services. So that's why I think that, the market may have run up a little bit too quickly ahead of expectations. So just to give you a sense of what we're expecting, we have a 2,600 target on the S&P 500 for this year. So I think, and targets are point-in-time targets are fraught with peril. But I think our view is that from here, the risk is to the downside in the market. And I would agree with Tepper that, stocks look pretty overvalued on almost any valuation metric you look at. But the one metric on which stocks look cheap is relative to bonds. So if you look at the dividend yield of the S&P 500, it's trading at almost 3 times the Treasury. We haven't seen that multiple on yields since the 1950s. So I still think that from an asset allocation perspective and for the long term, stocks, and in particular the S&P 500, looks attractive relative to bonds. And then on the clean reopening question, my worry is in China, you had a very top-down controlled policy where, the reopening was very sort of controlled, essentially. And in the U.S., we've had a much more fragmented, localized reopening strategy. So I think that could create more of a risk of a second wave of infections in the U.S. And that, I think, is another point to factor into the market that might not be priced in at this point.